We are almost halfway through 2023 and things are still crazy. So today we're going to go over what is happening, what's going on in real estate, and we're going to give my 2 cents with each topic we're about to cover. So now going into the real estate market, this coming from Charlie Munger, who is, he's one of the GOATs when it comes to investing. He's Warren Buffett's right-hand man. Says the U.S. commercial property market is in trouble. And Elon talked about this too. There's a lot of people talking about how there's a big problem coming in commercial real estate. One of the obvious ones I think for us to see is office and how the use of office has changed, primarily due to 2020. Companies don't have everyone coming into the office anymore. And so for a company, at least some of them, they found that by not having a huge footprint, that's a huge expense that they're able to save by allowing people to work remote. Well, in commercial real estate, primarily the value of the properties are based on the income that's coming in, right? The net operating income is really how you get to a valuation. If these buildings are vacant, I think the vacancy rate is getting close to 20%, which is that's financial crisis numbers. You can imagine what that does to the value of the property. So I'm expecting office is just going to get walloped. I think that's the obvious one. Another one to be mindful of, and this is actually what I think is going to be the opportunity, and I'll try to explain it in a simple way. When you build real estate, you're primarily taking out short-term debt. This is either like bridge debt or a construction loan. Maybe it's a 3-year loan. And you're doing that so that you can build it, you can stabilize it, which means you have tenants coming in that pay your expenses and your debt, and then you move over into your long-term kind of fixed debt, the good stuff. Well, if you were a builder prior to the Fed jamming rates up, you were most likely expecting your project to be in a totally different environment than we're in right now. The environment we're in right now, as you can imagine, interest rates are much higher, and the debt market is pulled back. It's not as easy to qualify for loans. And so a lot of those projects, as they get to the point of stabilization, I don't think a lot of them are going to qualify for what they were expecting to get financing for. I guess an easy way to say it is when they started the project, if they were expecting a bank to give them $50 million on the project, now they're only giving them 40. And they have to make up that difference. They're going to have to go out and find that money. Now, a lot of people are saying because there's going to be a liquidity need that all these operators or developers are going to get squeezed. Basically, they're going to get forced to sell. People are going to be gobbling up at a discount, and then you're going to see mass supply hit the market. We see a crash. I don't think that's going to happen, actually, because take office out of it, but whether it's industrial, hospitality is actually doing really well right now. If you're considering multifamily, even though it's residential, commercial residential, these are assets that have high demand and are good properties with equity in them. They're just not qualifying for the debt that they hope for. So I think you're actually going to see an opportunity where investors are going to come in and participate in either mezz debt or preferred equity. We don't have time to go into what those two categories are in the capital stack, but if you're interested and want to hear more about how a real estate project is put together, we'll do a video on that. Basically what it means in very layman's terms, the lower you are on the capital stack, the safer position it is and the lower return. So if you're first position, which is typically your long-term debt, you're the first one to get paid. So return is going to be smaller. And then as the stack goes, up to where you're an investor, an equity investor, you're the last to get paid. And so you get the highest return. What I mean by preferred or mezz debt or preferred equity being the opportunity, I think you're going to be able to sit in a safer position in the capital stack and actually see a higher return than if you were in the pref equity or in the common equity position. Hopefully that wasn't too much of the weeds and it helped.